All right. Thank you, everybody, for joining us here this afternoon or evening, depending on your time zone. Really appreciate it today. Got Eng Tyler here from Tozy Capital, and we're going to give you an update on Bitcoin Mining Fund 5. Just so you know, Hunter Thompson will not be able to make it here this evening. He had kind of a last-minute family emergency. Don't worry, everything's okay, but he just wasn't able to make the call this evening, so Eng and I will hold down the fort tonight for you. So before I turn over to Eng, hopefully I don't steal too much of your fire here, but just to recap a couple of quick things here. As many of you know, the fund initially got off to a bit of a slow start from an operations perspective. And as we kind of started to work our way through 2022, we really started to see the crypto market change pretty drastically. We saw contagion in the market. We saw massive industry players go bankrupt. Unfortunately, including Compute North, who was our hosting partner at the Granbury, Texas site. And despite a lot of those headwinds, there was a lot of excellent work that went into navigating the bankruptcy and the fallout from the Compute North situation by Eng and his team. I know it's been just a complete mountain of work to navigate that situation and get through it and to secure the new power contract. And when you look at what's going on in the industry as well, when you look at other folks in the industry who maybe they took out debt for their funds, or if you look at some of the large publicly traded miners who were massive companies and had massive valuations of several hundreds of millions of dollars, and the fact that a lot of those public miners are down 80 to 90%, and we've seen a lot of industry players who did take out debt who maybe went bankrupt. So in spite of us being in a situation right now where we're in somewhat of a Lehman Brothers moment for the industry, and it's definitely a tough time in the crypto industry. We certainly won't make any guarantees to you here on the webinar tonight, but the fact that there might be a pathway to a potential return of capital in the future, depending on market factors and how things play out, given our hopes going into this thing, it might feel a little bit like cold comfort given that fact pattern, but it could definitely be worse based on what we've seen in the industry. So really appreciate your patience and your understanding here, and we'll definitely continue to fight to do whatever we can to keep the fund headed in the right direction. So with that out of the way, Eng, I will go ahead and turn it over to you.
Thanks, Tyler. I appreciate the context, and I do want to just reinforce the point that I do believe we're making the best decisions based on the current options we have. But of course, I'm always open to alternative solutions if anybody has them. What I want to provide today is really an update on what's going on in the market, to reinforce some data points around hash price and difficulty, and talk about the thesis of what's causing these trends, and then ultimately dive into the impact of how all these things relate to our fund and potential profitability of our fund. Can you see my screen?
Yes.
Okay. It's not a long deck. I want to just go through some graphs and really talk about what's going on in the market, as well as provide really everybody an update on what we're doing with our fund 5 miners, and then updates on what's going to happen next. So I think it's good to look at this 1-year view of Bitcoin, and if you were talking to me a month and a half, 2 months ago, I would probably be in a much different space in terms of profitability. Obviously, we stopped distributions in late 2022, and a lot of that is caused because Bitcoin price went to a point where we were no longer profitable, given the current conditions. However, I believe it has turned around, and at today's price, we are profitable. And so we do plan to continue distributions given today's pricing. But I think it's always good to, I know that Bitcoin price is really the metric that people can see, and what you guys might be following day to day, and that's certainly something that I follow day to day. But it's not necessarily the metric that as Bitcoin miners we should really care about the most. And over the past year, Bitcoin has gone down by 50%, but more notably, difficulty has gone up in that same period, and it's gone up by more than 35%, and that has created essentially a two-tail headwind against what our initial expectations was. Not only did we purchase miners at a much higher price, but we purchased them with the intention of having them online in the summer of 2022. Given our contracts with Compute North at the time and the expectations they gave to us, this was a very reasonable expectation, and our expectation of difficulty was based on where difficulty was projected to be during the time. However, difficulty has continued to gone up, and one of the biggest surprises or really trends that has impacted everything is the fact that difficulty has not gone down as Bitcoin has gone down. And to reiterate what difficulty is essentially what we describe as the market competition for hash price. If difficulty goes up, that means there are more miners producing more hash rate, which is the computational power that our Bitcoin miners, our computers generate, which then turns into Bitcoin. And if you take sort of a multiplication of the hash price and the hash rate difficulty, you get hash price. You get Bitcoin price times difficulty is really how you get hash price. And hash price has gone down over the past year. And that's really the metric that I would follow if I was trying to follow the profitability of Bitcoin mining and specifically this fund. Because our miners generate the same amount of hash rate as they did a year ago, or would have been when they were plugged in, would have been plugged in. But that hash rate that they generate is generally worth less. And that's effective. That's the fact that difficulty has gone up, meaning that we're making less Bitcoin per miner, but also that the price of Bitcoin has gone down as well. So just to reinforce that point, that our current hash price is $71.5 at the spot per petahash, and some of these metrics I'm going to normalize to cents. So I like to really think of this as 7.1 cent of what they generate. And so it's a good way to look at it, because then I'm going to talk about the costs that it takes to run these miners, and it's a really great way to look at basically what our break-even price would look like.
So Eng, if we were to boil down the concept of hash price in the simplest terms possible, hash price is a good indicator for the profitability of Bitcoin mining. And if you look at the chart here, you can see back when we launched the fund and kind of the March, April, May timeframe, we saw hash price kind of ranging between 160 and 220, so much more profitable. And if you fast forward to today, you can see we're all the way down, kind of ranging in between 60 and 80. Did I explain that well? Is that kind of just a succinct, simple way to think about it?
Yes, that's exactly right. And that's very critical to understand, because while that's the gross revenue of a miner, the hash price, the net profits is much more compressed, especially around these levels. A miner could be generating 7.1 cents of hash price, but for every hash rate that they generate, it might take them 6.5 cents. So their profit margin is much more tight, and compare that to when hash price is 20 cents. 20 cents minus the same fixed pricing gets you a much higher profit margin. So profits have it squeezed dramatically as well. Of course, it could revert back to where it was, and a 20% increase in Bitcoin price keeping difficulty the same would generally mean that the profitability of Bitcoin miners would go up by significantly more than 20%. But of course, we're at the precarious levels we are now, where break even is definitely, we definitely cross that that line in late November and December. And one of the thesis here of why difficulty has gone up over the past 6 months, despite the challenging times of Bitcoin pricing, I think one of them is that when Ethereum moved to proof of work from proof of stake, which essentially means that Ethereum was essentially mining like what Bitcoin was. And in 2021, late 2021, Ethereum at certain months was making more in revenue than Bitcoin mining. But that means that a lot of computers that essentially were mining Ethereum were left in the lurch without any ability to generate profits when Ethereum moved from proof of work into proof of stake, which means that the same hardware could not be used for Bitcoin mining, for Ethereum mining. And so part of the thesis is that some of these miners switch over to Bitcoin mining, and they've been mining Bitcoin, which adds to the network difficulty. The second and the more impactful part of why Bitcoin difficulty trends has gone up is the fact that a lot of capital went into Bitcoin mining in late 2021. A very flush abundant capital, just the same type of capital that went into growth stocks, especially when you're getting 5 to 10% a month returns on your investment, and those investments take time to materialize and to fully allocate and capitalize. What that means is, when I make an order, a couple $100 million order for Bitcoin miners, typically they don't get delivered for a few months, and when they do get delivered, they get delivered over a 12-month period. And of course, that's just on the miner side. This other side is the infrastructure. And as we've seen with the infrastructure challenges with Compute North, expectations have dragged on, but a lot of people have still developed a lot of big infrastructure projects around electric generation and data center hosting. And a lot of those have started to get online over the past 6 months. And notably, the location that we will be in Wolf Hollow, that's essentially started to be online over the past month and a half. And it's very similar to an oil and gas investment. It takes a long time for these long tail CapEx projects to materialize. So even if Bitcoin price goes up dramatically or goes down dramatically, it doesn't really move the needle as fast as you would imagine. And when somebody puts in a couple $100 million of capital into a big project, they're unlikely to stop doing that project just because that's sort of seen as sunk cost. And then year over year, 2022 versus 2021, you've seen dramatic increases in pricing at the industrial rate. And of course, we're not necessarily paying the industrial rate. This is the average industrial rate for power. But this is sort of highlights the challenges that some of the data center providers are facing when it comes to essentially being able to provide sort of the same kind of pricing that we had expectations for in 2021, and that they use those expectations to provide contract pricing for Bitcoin miners in 2022 and 2023. And this is sort of good to understand, because one of the things we were looking for when we were engaging with Generate Capital and Compute North was really an understanding of what was the likelihood that we could fight a legal battle against Generate Capital to preserve our contractor rights at the much more favorable contract price that we initially signed at 5.8 cents. And based on my understanding of their true cost that it would be very unsustainable for them to provide that pricing, which means that they would take a much more hard stance legally um, to fight that contract, regardless of how valid the contract was initially with Compute North.
And one thing, just one more quick thing, I think it might be helpful to add on that particular thread. I know that another dynamic that's at play as well is that hosting space is very, very scarce right now as well throughout the industry. And if I'm not mistaken, I believe that, you know, when you were in the process of kind of negotiating that revised power contract with USBTC, there were some other really big Bitcoin mining players who are out there pawing around, kind of looking for hosting space for their miners. So, you know, there was potentially some pressure there that, you know, if we didn't act and if we didn't secure that power contract, you know, we didn't want somebody to come in and kind of bump us out of that location. I think there were some factors like that at play as well. Is that correct? Maybe you could just elaborate on that.
Yeah, so when we were negotiating on the contract, Celsius Mining has close to 50,000 miners that they were looking for a home for. And so they would have signed at the market rate, which is 7.5 cents or more at the variable rate contract. We have certainly looked at many different options in the market in terms of other sites and continue to do so. Of course, such as a backup plan. The challenge is, you know, a lot of these options are, you know, have a lot of promises of timing, and I'm very wary of those potential promises, those false promises, as you know, people could say that go online in 2-3 months, and as I've had many experiences, not just with Compute North, of that not happening. And timing is definitely of the essence, and I'll explain why in terms of essentially, you know, our time to halving. As the halving is sort of within the next year, you want to be online as soon as possible, because during this pre-halving time, you generate twice as much as what you would be generating after the halving. Halving essentially means that we're generating half as much Bitcoin. But that means also is just that we want them to be generating as much and be online as much as possible while we're before the halving event. And so any migration or move, while could be theoretically beneficial from a long-term power price perspective, would both introduce a large counterparty risk of essentially another hosting company, Bitcoin mining company. And what I like about Generate Capital and don't like about them as well is that they are very well funded. They aren't just in Bitcoin mining. They aren't really a Bitcoin mining company. So they have an operator, USDTC, to operate their data center. But what I like about well-funded companies is that they aren't likely to go through the same default and bankruptcy that plague Compute North, and that's plaguing Core Scientific and some of the other large companies. Which at a certain point, I was talking to Argo Blockchain and Hut8 and a couple other companies, and unfortunately, they were facing as much financial difficulty as they took on large loans, infrastructure loans, which they could not pay. So that would have put our miners at additional risk. And then one final point is, because we've made deposits, these are dollar value, but deposits, you know, to essentially secure our spot in with Hollow with Compute North. And part of the contract negotiation was that we needed Generate Capital to honor the deposit and essentially allow us to go in into the site, which we were already there, without any additional cash deposits, which would have been an incremental burden for the investors going to any other site, as anyone else would want a 2 to 3 month deposit, which typically for first and last month rent, as you can imagine, similar to any rent with property, And so this is sort of the easiest solution to proceed with.
Yeah, that's helpful, Eng. And if you do have questions, by the way, feel free to hit the Q&A button at the bottom, and we will do the best that we can to answer those questions kind of throughout the presentation, but probably mostly at the end as well.
Yes, and feel free to interject if something is urgent, Tyler. So the contract price that we engage in is variable rate contract, and the way that it's tied is based on what is the hash price and what is the hosting rate. What that means is it's very similar to a profit share model. We talked about the hash price being around 7.1 cents. Well, that's where in this first tier rate, which means that our current hosting rate would be at 6.25 cents. And his is $62.50. I'm translating it into that cent. So just follow along with that 7.5 cents of hash price. Our cost is 6.25 cents on hosting rate. And it's actually much more important, and this is an eye chart. So beg your I'm going to do some math here. It's one of the conditions of our fund is that we have bought miners that are essentially they're what's miners M30s, and they're not the most energy efficient miners in today's market, and that wouldn't necessarily matter. That wouldn't matter except for the fact that you want as low of a potential pricing as possible. And so going for a fixed rate contract of 7.5 cents means that we're unprofitable at that price, or at least we're very much at that line where that it's potentially unprofitable. So M30s, which we purchased at the time when we launched the fund, were the best bang for your buck, meaning that they had the best productivity per dollar value, hash rate per dollar. And when Bitcoin's at 40,000 and 45,000, all these discussions of efficiency didn't really matter. In fact, what's miners have been shown field tested to have better longevity, which I'm still a big believer in and could be a benefit. But the more efficient miners are, these newer gen miners and Bitmain miners. And the way I would read this is every column is essentially a tier of what hash price could look like. And right now we're in tier 1, so our profitability right now is around 7.6 cents. It's this column here with the 7 of hash price, we generate around 7.5 cents of essentially of revenue for our miners, whereas our cost is 6.25 cents. And when it goes up to this second tier, our cost would be 6.5 cents. And respectively, as it goes up more and more, we do make more money. So our profitability goes up, but our cost goes up. So that's what I talked about, the variable rate contract. And to more simplistically illustrate this point, I want to show another chart where, given our difficulty remains the same, which is of course not possible, if Bitcoin goes up a lot, but just want to just normalize that thinking right now. At today's price, we would be generating 0.4 cents in monthly distribution based on if you invest $100,000, you'd be getting that 0.4 cents distribution, or $460. And our hosting price would be 6.25 cents. And of course, this monthly distribution is net of that hosting price, of net of our costs. And if Bitcoin goes from 21K to 30K, we would actually be almost tripling our monthly distribution, and our hosting price would be at a subsequently higher tier. I think the third tier, which would be 7.5 cents. And of course, this monthly distribution is net of that hosting price. And so subsequently, you see the chart go higher and higher. and of course, monetization go up. And of course, what our hosting price is capped at the 11.5 cents level. So 11.5 cents, we would be, making a lot of profit. So that would feel good. Of course, we would probably be kicking ourselves as well, in terms of probably looking at the market and seeing that, well, we could have been at a lower price point. So this variable contract we chose was mostly in mindset of the fact that we wanted to protect ourselves from that bottom, from unprofitability, to keep as profitable later as possible. And another thing to consider is that when hash price, when the halving happens, it's actually hash price goes down in half. And so that can potentially help us, as that would change the hosting price as well. But of course, we're hoping for Bitcoin price to go up. And if I was creating a model for essentially a break-even model from today, the more important thing is what does Bitcoin do in the next year before the halving, when we are able to generate the most amount of Bitcoin, and essentially pay back to investors. And this is a model projection based on if we were selling Bitcoin every day, if no one was taking Bitcoin. So any appreciation of Bitcoin going from today to in the future is not taking into account for the investor. And this is also based on today being 21,000, going to 60,000 within 12 months. Of course, that seems far away from now. But 12 months ago or 15 months ago, that it was very much 60,000 or above. So that's the presentation. I talked a lot of math, talked a lot of, happy to open up to questions.
Sounds good, Eng. I do see in the chat here, we have quite a few questions starting to roll in here. So maybe we can just kind of start hopping into some of these. We've got a question about the various different funds. So it's wondering, what was the impact on the other funds 1 through 4? Does the Compute North issue and energy issue, does that impact the other funds equally? What's the impact kind of across the funds of the issues we've had at the Granbury site?
Yeah, the major impact has been on Fund 1, where Generate also purchased from Compute North. So we had to essentially sign the same contract where we were at 5.5 cents. Fund 4 is also impacted, where the vast majority of the miners are at the Rough Hollow site alongside Fund 5, and Fund 5 is impacted.
Okay. I see a question here on difficulty and why that is not going down, but I believe we touched on that in quite a bit of detail already. So let's kind of go ahead and skip across that one. Got a good question here. Are you monitoring mining opportunities across Ethereum and other coins? Is it possible to switch mining other coins that are more profitable than Bitcoin, if any exist?
Yeah, I think that's a great question, and something that we're not actively looking at in terms of additional coins. But the more interesting thing is when Bitcoin was very profitable in 2021, one of the more, and before the Chinese ban on Bitcoin mining, one of the things that we saw was essentially the percentage of fees related to the transaction layer of Bitcoin, meaning that if I send you Bitcoin, I would have to pay a miner. And this is all automatic, of course. I'm not I'm choosing to pay a miner. I tip them based on that service fee of sending that Bitcoin to you. Think of it as a Visa network. And right now that network pays 2.41% of what we would. So of all the Bitcoin we earn, 2.41% is basically fees. In the early 2021, when a lot of people were using Bitcoin to send Bitcoin, and before the last update to of Bitcoin network, this represented nearly 20%. And the thesis around Bitcoin mining is that while these block rewards go down over time, it's sort of a diminishing return of potential, As the network expands and more people use the network of Bitcoin and use Bitcoin in general, the fees will go up. And of course, what has happened is that what has happened is really that stable coins have really taken over that use case of transmitting monetary money over cryptocurrency. But more recently, if anyone has been following the latest trends, ordinals, Bitcoin ordinals, which essentially is NFTs on Bitcoin, has started popping up, and that's created a lot of buzz. I'm not saying that's going to help create a lot more value, but the fees, essentially what I've seen is fees have been spiking up and going up, and so I would look out for that in terms of a potential benefit in the long run.
That's helpful. And what about investigating markets that might have less expensive electric power than we're now seeing in Texas? Sounds like we have our participant here who potentially has found pricing as low as 4 cents per kilowatt hour in Idaho. There could potentially be 3 cents per kilowatt hour in Washington. It sounds like he's not entirely sure about that, but I guess kind of broadly speaking, what does that look like? Are you seeing pricing that's potentially cheaper in different markets? What's that look like?
I get a lot of potential leads, and I chase them all down, where I'm seeing 3.5 cents and 4 cents, and even in Texas, it's not like our cost is 7.5 cents or 6.5 cents. So the energy cost to mine there is typically around 5 cents. When you do curtailment, which you have to do essentially over the past few weeks, when it's been freezing in Dallas and energy prices shoot up by 10x to 20x or 50x sometimes, you had to shut down, and that shutdown essentially allows the miner or the Bitcoin the data center to reduce their cost by close to 20%. So their true cost of power probably is closer to 3.8 cents or 4.2 cents. So similar and along the lines of other sites. But what we're almost always forgetting is the cost of CapEx, because no one's going to give you power at its core price. They want a spread, and that spread will be determined based on how much you help fund and develop their data center. Or if they're developing funding the data center themselves, then they need to earn that money back based on the spread on power. So typically you're going to get closer to 6 and 7 cents. And the market being what it is, you're not going to find the way to get really cheap power is to go to riskier areas where either the company isn't proven or the site isn't proven, or you're essentially helping partner and providing capital to build the site out, where essentially giving a loan, which essentially what Generate Capital did to Compute North. They gave a huge loan to essentially capitalize, and they saw the 2 cent spread, which would have paid back over close to 3 years. And for infrastructure loan, that was a very healthy return, based on that they weren't thinking that it was backed by Bitcoin or anything. It was basically backed by a contract and a spread on that power contract. So these are things that I do think about, but although I am not saying that there isn't possibility that we'll see much cheaper pricing, but typically if I do, why aren't they selling it to someone else for 7.5 cents, which is the market price, and selling it to us for typically as a catch.
That's a really helpful coloring. What about the status of the fund right now in terms of Granbury, Texas, and getting it energized, getting those machines hashing again? Do you foresee hashing beginning soon and distribution starting soon? What's kind of the current status from that standpoint?
Yeah, around 15% of the miners got started hashing on Friday. The expectation is that the rest of the miners, or probably 80% of the miners, will be hashing by this week. I just got the word from our director of operations that there was a transformer swap, some infrastructure thing that's going on, but basically that they should be going online more and more. The last time we visited the site in the beginning of February, I did not personally visit, but my tech crew visited. We did observe around 40% of the containers and imagine these rows of containers are basically humming and turned on. And so essentially they're trying to get more electricity pumped into the site and get the rest turned on because our miners are there, they're ready to go, they're plugged in. They essentially, it's just about the electrical infrastructure being ready at the same time.
Perfect. All right. There's a question here about why don't we just sell the miners? And there was some discussion in some of the original presentation materials about, hey, look, when Bitcoin goes down, typically the miners don't go down quite as much in value. What does the market look like for selling the miners? Why don't we sell them right now? Would love to hear you elaborate.
Yeah, miners essentially act as a call option on Bitcoin. And while so initially when Bitcoin price went down, miner price was slower to go down. But as sort of electricity costs went up and the availability of cheap hosting went down, and all these counterparty risks presented itself, miner prices went down even further. And so if we sold our miners, we would be taking a very significant drawdown and loss. And so this is something that we'll have to gauge a few investors with, and I don't think that's something that we would want to do, especially since we're just now getting started. And hope, obviously, we hope that there's no more hiccups going forward, and that this thing sort of just starts running more smoothly.
Yeah, that makes sense, Eng. All right. Okay, so thinking about the future, what is the exit strategy? Can the mining computers be sold? Are the mining computers only good for Bitcoin mining, or do they have alternative uses? Is there any kind of residual value at the end? What is it? Maybe just kind of explain the business plan in terms of like the next few years and the business plan and how we kind of anticipate it going from an exit perspective.
On a very individual case-by-case basis, some people have asked for miners as sort of an exit, and I have been providing that in some of our other funds, where essentially we've been sending them the individual pro rata ownership of miners. Maybe they have cheaper power; they can just plug in. In terms of use for anything else, these are single-purpose ASICs, so that they're essentially used for Bitcoin, and at the present moment, the most profitable for Bitcoin.
All right. We've got a couple questions in here around a revised pro forma being sent along. And Eng, I think you kind of touched on that in a couple of the slides here. We will 100% make that available for anybody who wants it. After the call here, we can circulate the slide deck. Certainly take some time to digest it. If you have any follow-up questions, feel free to reach out to us at investors@asmcapital.com, and we'll answer any questions that you might have on that pro forma. So Eng, if we could plan to circulate that slide deck after the call along with the recording, I think that would be super helpful. Jumping into a couple of the other questions here. Is Tozy planning to launch any additional Bitcoin mining funds? Why or why not? Yeah, would love to hear you. Love to hear some color on that one.
Yeah, I think I think the lesson learned is that even though anyone can, we can do the best we can on the math and projections, the big thing that is hard to estimate is counterparty risk. And without a large source of capital or control of energy sources, it would be unwise to do so, given counterparty risks. So at this point, my expectation is that we would not be launching any Bitcoin mining funds. I'm really focusing on, in fact, Tozy has not really launched any new funds for the last 6 months, and we're really focused on of any kind. And so we're focused on maintaining and making sure everything it's best situated as possible.
Excellent. There were also, one second here. There were also some questions with respect to the miners that were in Minnesota. For the investors on the call, you might recall we've got some in Granbury, Texas. We got some that were relocated to Minnesota, about 25% of the miners. What's the status of those current miners in Minnesota? Presumably, they're still there and hashing when it makes sense to. Maybe you could give us a quick update on the status of those miners and kind of what the longer term plan is for those miners. Are they going to stay there? Are they going to go to Texas? Please provide some color there.
Yeah, so they're hosted with Compass through an arrangement we had with them. And they are on a 5-year contract, so same term as the one we just signed with General Capital. And they're mining now. And so part of the distributions, so I believe we should have some distributions, although we're still gauging whether we should distribute that as part of this month's distribution or we wait for next month's distribution to send that out. Although right now we are profitably mining in Minnesota.
That sounds great. And we wouldn't have seen distributions the last couple months because we just recently saw a run up in Bitcoin price, right? I mean, in November and December, it was more depressed. We've seen the run up more recently. So yeah, hopefully it'd be great to see distributions out of those miners sometime soon here. And then longer term strategy, since they are hosted with Compass, presumably, solid operator there. Is the plan to kind of keep them there for the full 5-year term? What's your perspective there? Presumably there's moving costs and whatnot to move them, but would love to hear you touch on that as well.
Yeah, I really hope that we no longer have to move any of our miners anywhere. The amount of Excel sheets and serial numbers I've been looking at and tracking all these things is hard. At a certain point, I have definitely asked if there is more capacity at the Minnesota site. But I guess at this point, I'm happy that we don't have additional capitalization needs in terms of deposits. As we have those deposits there, and it's always good to have some diversity in terms of different sites. Minnesota is very cold, so when it's very cold, it generally don't perform as well, mostly because energy has to be curtailed. But right now it's running smoothly.
All right. Okay, so asset management fees. Are there any asset management fees paid during this time?
No, there's no asset management fees at all. There's no asset management fees paid in time. In fact, I've cut costs across the board, and Tozy has actually paid for all the legal fees, and even during the months where we were running unprofitably, I was still paying for the electricity costs because we would be breaking the contract, and it would take it would be very much harder to get back on a contract than just to bear it out for a few months, which is what actually happened.
All right. There are a couple questions here that are somewhat pro forma related here. So first one being, what price does Bitcoin need to be above for us to be profitable?
That's a great question, and I think that's it's closer to like 18,900. 19,000 is probably a good barometer right now.
Okay. And then in terms of a potential new timeline for return of capital, what might that look like based on kind of the current pro forma and expectations?
So based on what I just showed in the pro forma, being where it is, that's based on a 5-year return of capital. So at the end of 5 years.
Makes sense. And obviously there are a lot of assumptions that go into that pro forma as well too, right, Eng? So no guarantees there, but.
Exactly. So the other assumptions I've been making is that typically will continue to go up. It will so slow down over time, second half of 2022 or 2023, and that our miners will essentially lose hash rate at a 1% per month impact. Essentially 1% of miners essentially would be unrepairable. Although of course, if Bitcoin price is very high, we would spend the money to repair them. But just putting that out there as well, which means that by the end of 5 years, essentially half our miners could be in non-productive, and that's baked into the model.
That makes sense. Let's see what else we have here. We're getting toward the end of these. When do you anticipate making the next distribution?
I anticipate making this next decision in mid-March.
All right. Just scrolling through here to make sure that we've addressed all these. I think we've covered all these. If we did, for whatever reason, miss any of your questions, feel free to email us at investors@asimcapital.com, and we'll do whatever we can to get back to you as soon as possible on those questions. We will go ahead and circulate after the call here. We'll send out the slide deck so you have that. If you do want to study it a little bit closer, you'll be free to do that. And of course, for folks who weren't able to make it, a recording will be sent out as well. Eng, really appreciate your time here today. I'm just looking through. Actually, I got a couple more popping in here. One second here. I think we've kind of touched on this one earlier, but maybe it makes sense just to put a finer point on it, Eng. Do we have any other strategy at play here to potentially be more profitable?
Yeah, I think there's a couple of ways to look at Bitcoin mining. One is a commodities play. You can buy and sell miners. That means a lot of moving pieces, a lot of counterparty risk. So it's something I would advise doing. And we can always sell the miners and then buy it cheaper somewhere else and then put them in a new place. That's just a lot of moving pieces. That's something that I want to do. And given the history of counterparty risk, not something we want to do. A lot of miners do not sell the miners on a monthly basis to pay for power. They usually have a cash reserve, or they're well capitalized. They raise capital. The impact of that essentially, if you think about it, if you're not selling Bitcoin to pay for your expenses, then you're effectively buying Bitcoin at that price. And of course, a lot of miners were buying Bitcoin at 60,000, 65,000, essentially by not selling the Bitcoin and then having to then sell the Bitcoin. So our strategy has always been to sell miners Bitcoin. But if we believe that Bitcoin is going up, and I certainly do, don't know the timeline or the velocity, it would make a lot more sense to not sell and to try to buy miners or pay our price, housing price for something else. Typically, what that would look like, essentially, you would take leverage on the future profitability. And of course, leverage presents additional risk. So nothing that we would likely do. But if you're asking about other options, the other option is really tied to public market exits. Public market does seem to be maybe showing signs of life, although maybe not for Bitcoin mining. All this really ties still to hash price and Bitcoin mining profitability. Potentially going public is a better beta for, or better alpha for our ability to get more profit when things are good. And so it's just something to look into if the market turns around.
Excellent. That's helpful. And Eng, we did have an investor chime in and just say thank you for your efforts. This is a tough situation all the way around, and I echo that sentiment. I know it's been difficult. We appreciate you fighting for us and our investors, and know it's been a bit like crawling through glass for you and the team the last few months here, trying to rectify the Compute North situation and figure it out. To all the investors who dialed in this evening, we really appreciate your time and effort as well. As always, feel free to reach out to us if you have any questions for the ASIM team. It's investors@asimcapital.com. We will definitely try to get back to you as soon as we can. Investors, Eng, everybody, thank you again for your time. It is very much appreciated. Thank you so much.
Thanks, guys. Have a good day.